So let's talk about some cash deals versus seller financing deals. Again, one of the key is that you don't want to go blind into a deal. Basically, you look at when you get that deal, when you make that offer, when you get that offer accepted, or ideally at the point of making the actual offer, you want to go and make sure that that you already have, in a way, in the back of your mind at least, a plan for that deal. So obviously, when what Aaron said earlier, if you have $100,000, if you know you can sell properties for $100,000 and you make $70,000 offers, then your plan is to make that a cash sale, right? Because you got somebody that immediately can pay you $100,000 for it. If you want to, as a strategy, if you want, like the gentleman earlier, Kreshmir or something, what was his name? Kreshnik, I think. Kreshnik mentioned that you have, if you want seller financing deals, then you got to approach your deals a little bit different, and you got to make different offers. Because if he wants to do a seller financing deal, then offering $70,000 on a property that he can sell for $100,000 is not going to get him to that result. It's going to get him to $30,000 in cash, which he then can actually turn around and then perhaps self-fund some seller financing deals, but it's not immediately going to get him seller financing deals. So in essence, when you look at it, if you have a high value property and you offer a high price, that's a wholesale deal. Because otherwise you don't get as a down payment as much as you need to. If you have a high value property and you offer a low price and you get it accepted, then that is a great candidate either for a wholesale deal or for a seller financing deal. Obviously, you can always wholesale. If you have a super low price, like something like what's mentioned earlier, Roland mentioned that you get a super low price and a super low value. That's the kind of deals that I think the lady, what was your name again? Andrea. That was Andrea is sometimes doing. I bet some of these deals you sell for seller financing too, right? Almost all of them, yeah. So she gets them for $300, sells them for $4,500, and you probably get what as a down payment? $300 to $500? $500 as a down payment, yes. How did I know that? Because we've probably done a few hundred of those ourselves, right? So you get it for you get it accepted for $300, sell it for $4,500 with a $500 down payment, monthly payments of what? $149 or $97 to $200? $99 to $149. Yeah, $199, $99. How did I know that? I don't know. $99 to $149, so that she'll need like 15 deals to do that. But again, those deals, they're like everywhere, and there's lots of them that you can do that. Again, different exit strategies and different goals drive different strategies in how you do this. So, for example, let's look at just a couple of examples. Look at some of the ROIs. You put the deal on the contract for $25K, value is $50K, you sell it for $50K. This is a retail deal. The profit would be $25K, but if you sell it for retail at $50K, no seller financing offered, this deal is going to sit there for a while. You make 100% ROI, great, but it's going to take a long time to sell. Actually, we sell it to people who do this. Like we repeat customers. I can think of one of them. Alex is his name. He's a nightmare to deal with, but he's a nice guy. And he buys lots of properties because he always wants to negotiate more and more and more and more and more and more and more until you yell at him, and then he knows you got to your limit. So now it's very simply, I yell at him faster. And he backs off faster, right? But the point is he buys properties from us, and we take a $50,000 deal. We get it on the contract for 10, but we sell it to him for 25. Which is a wholesale deal, but then he does that. He buys it from us for 25, and then he puts it on the market. It might take him a year, but he has a very cash-positive jewelry store that produces a lot of cash. He knows what we're doing. He doesn't want to do what we're doing. He just takes his money, buys them from us cheap, and makes 100% return. Is that a good deal for him? Yeah, of course. He has basically ways to get, on an ongoing basis, 100% returns on his money. So if some of you guys have perhaps a larger amount of money, then you can actually buy wholesale from other people, put them on the market in good markets, and still make good returns without actually having to have the marketing expenses. So by the way, that's also what realtors try to do. Basically, they try to sell it at their price, and then the property just sits there. Wholesale example is another example. So wholesale example, you take that same deal, but you don't want to wholesale it. You don't want to buy it at $25,000 to wholesale it. You want to buy it at $10,000. So put it on a contract for 10. So you put it on a contract for 10, then you turn around, you sell it for $35,000, and you make a $25,000 profit. Now I'm ignoring closing costs, but closing costs are usually only about $1,000 or $1,500, and if you do it right, you can actually stick down, have the buyer pay a lot for a lot of them too. So we'll just, if you want to consider closing costs, just subtract $1,000 or so from your proceeds in here. All right, so it's a $25,000 profit. That's an ROI of 250%. That's a better ROI, right? It's a deal, and they sell much faster and turn money much faster, but obviously with that strategy, you got to work a little bit harder to get the deals under contract at 20 cents on the dollar. Now, if we look at owner financing as a third strategy, you have the same deal. The deal is worth $50,000. You put in a contract for $10,000, and now you are, but now you're doing a different kind of thing. You actually sell it, let's say not for the full 50, but just for slightly discounted. You put it a little bit below market to make it a little bit more attractive. And then you go and you say, hey, I still want about a $10,000 down payment. That's a 22% purchase price. Is that a reasonable down payment? Yes. Yes, it is. So reasonable down payment of 22% or $10,000. So in that case, you can already see you owe the seller $10,000, but you're getting $10,000 as a down payment. You can make that deal work whichever way you want. There's, by the way, on the sales side of that deal, there's no title company involved. You don't need a title company to sell a property with seller financing. There's no title company included on the thing. You simply use some of our documents, which are seller financing documents, where the buyer just signs it, gives you the $10,000 as a down payment, and now starts making monthly payment. And it's all already set in there. Right? So now these monthly payments might come in for 15 years at around a 15% interest rate, at 12 to 15% interest. I think these numbers are calculated at a close to 15% interest rate. And as a result of that, what happens? The benefit number one of the seller financing situation, you get what you paid for the property at closing. You get $500 of cash in cash flow per month. That's $6,000 per year. For 15 years, every single one of these monthly payments are profit. Over 15 years, that's $90,000 that you receive, plus the $10,000 down. So that's $100,000 you receive over 15 years. Obviously, how much did it cost you? It cost you $10,000. So therefore, your profit is $90,000. That's a ROI of 900%. Anyone okay with that? Now the question is, annual ROI in this case, on the $10,000 that you, at least on paper, invested in the deal, is 60%. Anyone concerned about inflation when you make 60% ROIs? Right? No, exactly. So the other thing is, particularly when you have all your money back, and this is really an ROI without having any additional money in the deal. So if you look at that now, the question is, what is better? Which of these three strategies is better? It depends, said somebody. Who said it depends? That, exactly. It depends. It depends on where you are in life and where you are in your need. What do you need? Like, if you have a whatever bill that you need to pay in the next year of $100,000, then the seller financing deal won't get you there. Right? If you have to have, but if you do, in that case, what you need, or if you have urgent need for cash, then you want to do the cash deals. Right? The seller financing deal is 4 times the profit of the wholesale. The benefits of, because the benefit is the high price, the deal is in the affordability of the down payment and the monthly payments, low down, low monthly payments, no credit checks, flexible interest rates, because again, who is the bank here? You are the bank. Right? You are the bank. So therefore, and it's also a fast sale because you're not asking for the full market price in cash. You're asking just for a low down payment and a monthly payment, and that accelerates the sale dramatically. Like I remember one case where one of our students said, like, they had a property under contract for $8,000, and they said it's worth like something like $70,000 or so. So they put it under contract. They put it on the market for something like $60,000 or close to market value, and just said like they want cash. They want cash. They wanted to cash out, and the deal would just not sell. And I just told him, like, dude, just go and sell this with seller financing and just ask for 15% down payment. And he's like, no, I need cash, I need cash. Well, it wouldn't sell, it wouldn't sell, it wouldn't sell. So he finally said, okay, he did that, and he asked for it with a down payment of $9,000. 4 days later, had a sale. Why? Because, again, people are interested in, they're like, well, I want the property, but I don't have $60K. Well, I want the property, but I have $9,000. It's more likely scenario. So they paid $9,000 and they paid something like $400 a month and so on. So the benefit also of the seller financing deal is pure passive income. So now, and then again, the key is to really understand to that concept is that people buy what they can afford the monthly payments for, not what the purchase price is. Like I remember when Michelle and I bought our very, very first home, we were qualifying for it was a $151,000 starter home. Now that's 24 years ago, 23 years ago, 2001. And the lender told us, hey, you guys qualify for a loan that's like twice as much. But I just looked at them and was like, why would I do that? Like, I don't need a huge house. I just need, my first house, our first house. So we bought what we thought was right for us, what we thought we could afford, where we still had money left over. But apparently that's not the way how most people think. People think, like, let me go for the biggest, let me go for the thing. And that's totally fine. But but as you now switching over into the seller, into the lender side of things, you also want to be aware of that. Because that's just how people are. So as a result, people are used to paying monthly installments. Cars are sold like that. Houses are sold like that. Most people don't buy a house cash. They go for the biggest house they can go, that their down payment and their monthly payment can afford them. And that's okay. So why not do the exact same thing with land? Why not do the exact same thing with land? Right? So by the way, what's the alternative? A bank loan? No, we already established that banks don't give loans on that. So banks don't lend on land. So as a result, they don't have an option. They want that piece of land. They don't have the money. The seller financing is a great option, right? So again, and you now become the bank, and you now get paid, and so on. Now, by the way, how to do these deals without using your own money? Well, let's talk about double closing. And the double closing, the basic principle is that you use the buyer's money to fund the entire transaction. So let's say it's the same deal, $50,000 property, have it under contract for 10 grand, sell it for 30K cash, a similar deal. Sell it for 30K cash. And the second alternative of that deal is that you sell it for 45K with a 10K down. So let's look at both of those alternatives to each other. So in both cases, if you look at that, in the top case, in the first case, you have a property, you have two sale agreements. You have a sale agreement with a seller for $10,000. And you have a sale agreement with a buyer for $30,000. So you can take those two, put them into the title company, and then basically have the title company send different sets of documents to the different parties. So for example, the seller signs a deed over to you, signs a deed and sends it over to you, or sends it to the title company. You sign a deed and send it also to the title company, and at the same time, you actually sign two sets of documents in the double closing, because you're both the buyer and you're the seller. So the seller signs the selling documents, you sign the buying documents, buying this property from the seller, and then you're also signing the selling document because you're selling it to the buyer. Right? But then the property, what happens is that the title company, but only one person sends money in, and that's only the buyer. The buyer sends $30,000 into the title company, plus perhaps closing costs, so $31,000, $32,000. So the title company now has $31,000 or $32,000. Is there a chicken dance coming here? Make sure you put your phones on mute. Right? I'm going to finish this up, otherwise we get interrupted. But the buyer sends the $31,000, $32,000 into the title company, and the title company now takes that and sends $10,000 to the seller, sends the deed from the seller to you for recording, then sends the deed from you to the buyer for recording. The title company now keeps $2,000 for their efforts, and in this case there was the buyer didn't send any extra money in, so the buyer just sent $30,000 in. The title company now sends the remaining $18,000 to you. Does that make sense, guys? You just basically did a deal, made $18,000, and didn't put the dollar of your own money into that deal. Now, this exact same thing, by the way, happens with the seller financing deal. the exact same deal happens. In this case, it's only that how much do you owe the seller? $10,000. How much is the buyer giving you for the deal? Whatever they give you, $45,000, but how much is their down payment? $10,000. So in that case, what happens is it's the exact same thing. The buyer puts in $10,000, plus perhaps some closing costs, and then the title company takes of those money that they have, sends $10,000 to the seller, keeps the closing cost money, and then again records a deed from you, and then executes the seller financing documents with the buyer. And you just bought the property, sold the property, and now where the cash flow starts coming in without having actually put any money into the deal. When I sell a property as a wholesale, we're transferring a deed. If we're selling with seller financing, do we also transfer a deed, or do we do a contract for deed or a document that transfers that we don't transfer the deed? The answer is you do whatever the heck you want because it's your business, and there's really 3 different ways to do it on the seller financing side of things. You do either what's called a contract for deed, or like a land sale agreement, like contract for deed. The second one is, which basically means they make payment. It's a sale agreement. It's a clear sale. They're gaining equity, but they're not getting a deed until they paid off. It's option 1. Option 2 is you can do a deed of trust and note, which in many states is the standard document when you buy a house, in which case you transfer a deed, but then you get what's called a deed of trust back, which clarifies the rules, and a note, which clarifies the rules. The foreclosure on that is typically a little bit more involved than the first case. And the third one is that we'll talk about that on Sunday, I won't go into it much more, is actually what's called a lease purchase agreement, which in this case, you make it a lease, so they're renting the land from you, but with each rent payment, they get a credit towards the future purchase price of the property. And then over time, as with each rent payment, once they made enough rent payment, what's left for them to pay to buy the property is basically 0, and then you give them a deed. And the benefit of that is that technically, since it's a lease, you can evict them instead of foreclose on them, and that is obviously much, much faster. But in that case, in the third case, you also don't give a deed. But the key here is, therefore, that these notes have value. These notes, if you sell somebody, because all this interest here is additional profit. So somebody's going to be willing, all that interest there is additional profit. So somebody's going to be willing to buy that note from you, because when they buy that note from you, who gets to receive that interest? They do, right? They do when you sell the note to them. And a lot of people are interested in doing that. So if you do 20 deals like that, you have $660,000 in note at this kind of $35,000 level. Like, if you do 20 deals like you have $660,000 in note. After 2 years, you have $1.28 million in notes. Anyone looking to become a millionaire in 2 years? Do $35,000 seller financing deals where the note balance is $35,000. Do 20 of them a year. After 2 years, your note balance is over $1 million. And then what you do, you go outside the room here, go to PaperStack, put those notes up for sale, and sell $1.28 million in notes for something like $1.1 million, pay some taxes, or $1.2 million even, perhaps if they aged already a year to 2 years, and they have high interest rates. There's note buyers that buy those at almost face value. So you sell them for $1.2 million, pay some $200,000 in taxes, and walk away with $1 million. Anyone okay with that? Right there is your path to becoming a millionaire. And every single person in this room can actually do this. So you got to sell them for $1 million, or in this case, it's an extreme example. Worst case, you have to sell them for $1 million at 78% of note value. But really, you can probably sell them in the current environment with a platform like PaperStack out there. You can probably sell them for $1.2 million. Or what else can you do? You have $1.28 million in notes. Can you go to somebody and say, like, would you lend me a $600,000 against those notes? That's less than 50% of your note value. Yeah. These notes are value, they're assets. If you look at the balance sheet, they're part of your asset side. Your net worth has gone up by $1.28 million when you have those notes. Right? So now you can use that, borrow $600,000 against them, and use them as down payment for a $3 million commercial property that spits out $100,000 or $200,000 in cash flow per year. Could you do that? Yes. Right? There we go. Could you trade them against some houses? Like there's one really famous, one of the legends in our industry is Peter Fortunato. And Peter talks about, when I talked to Peter last time, and I saw him a couple of months ago, and he's like, his eyes, like every time that we talked, he's like, yeah, you can take those notes, you can sell them against houses and trade them against things. He's like super creative in the real estate kind of things. Also, instead of selling the note, you can, instead of selling the note, you could simply go to your actual borrowers, the people that make the monthly payments, and say like, hey, would you be interested in paying off your note if I give you a 10% discount? You'll be surprised. People do not only take seller financing because they need it. People very often accept your seller financing offer because they prefer to have cash in the pocket and have the property. Don't assume just because somebody takes seller financing that they don't have the cash. They might just choose to do seller financing. So you can reach out to them and say like, hey, how about I give you a little discount? Do you want to pay it off? So instead of selling the note, you can do that too. Right? You get 85 to 95% of the note value in this case, right? Or again, sell the note close to full face value to a platform like PaperStack. Right? Also, look at some of these things. Like, let's talk a little bit bigger here, right? Because let's talk about what if you do that now for a few years and you've built up a few, like literally a few $1 million of this note value. Like, did you know that if at that point you're like, okay, I got this, now it's time to work on my what we call forever cash, right? Forever cash strategy. Forever cash strategy is very simply, we define money into three kinds of money. One-time cash, you work for it once, you get paid once. Wholesaling is that. It's a high-quality one-time cash, but it's that. Second one is temporary cash. You pay for it once, you work for it once, and you get paid for a while, but then it eventually stops. It's like a seller financing deal. It's temporary cash. Well, forever cash is you work for it once, you get paid forever. Well, what if you now make all this money, have all these seller financing deals, but eventually you now want to roll it over into something or buy something that you can hold on forever, like a nice apartment complex and so on. Well, guess what? To qualify for Freddie Mac or Fannie Mae multifamily loans, your net worth needs to be equal or higher to the purchase price of the property that you're buying. So in other words, you want to buy a $3 million apartment complex, you have to have a $3 million net worth. Now, if you go with a local bank, they don't requirement, but Freddie and Fannie, which have the best interest rates, et cetera, they do that. So guess what? Now, so use your note balances to qualify for that. Because if you build up $1 million, $1.5 million, $2 million, and then you have perhaps other assets and you have a house and other things, soon enough you'll have a net worth of multiple $1 million that you can use to qualify for one of these loans. At least you want to know about that and so on. Now again, what does it happen? So when you do these self-financing deals, the cash flow can be absolutely tremendous because you look at that. This is a deal from John. He's bought it for 30. Okay, he sold it with seller financing for 260, and at the end of the day, it will gross $266,000. Also, be creative with those deals. Like for example, creative in doing seller financing. I actually love this story because we had a live event just like this one, and I actually shared this story, and there's a guy in the room that says like, yeah, that was me. And here's what happened. He basically, Shaman, he bought the property for $3,500, sold it for $32,000. But the problem was that the buyer, with seller financing, the buyer only had $700. So the buyer said, so here's one question you can ask when you talk to a buyer in that particular situation. And the question is, what else do you have that you could put down as a down payment? Some people might offer you a car or a motorcycle or something like that. In this case, he offered a horse. He basically said, he said like, and now I'm the proud owner of a horse. Don't know what I do with it yet, but I was included in the deal. Never thought I own a horse, but I love being creative, and if nothing else, it's a great story for my kids. And then at the bottom it says, by the way, this is not the picture of the actual horse. Right? Because that horse is probably worth way more. So the point is, be creative, guys. Don't be afraid of these kind of things. He had a horse. So also, Sue and Gretchen, they bought a property for $1,000, sold it for $18,500, and it's including interest, it's $25,000. Again, these interest portions make a huge difference. So when Michelle and I discovered that, we put the pedal to the metal, built that passive cash flow up as fast as possible, and we built that up to over $71,000 a month in monthly payments. So, thank you very much. $71,000 a month in monthly payments. Land flipping right now is an opportunity to get, when the market is the hottest it has been for a long time, and make that, and build that up, build that cash flow, build that net worth, build that income, build that reputation, so that when then, whatever the opportunity may be in 2, 3, 4 years in the future comes up, you can turbo boost your net worth and your income. Because just the rental houses that we have, they spit out a multiple six-figure cash flow for life for us. So and that's you guys get the point. It's not just about land flipping here. It's about this land flipping is the entry point, is the perfect strategy to literally get to the point that you can take advantage of any kind of opportunity that comes your way down the road. Does that make sense? Who's excited about that? Give me a heck yes. All right.